Welcome to the Wealth Studying Podcast. This is episode 453. Today is September 8th, 2024. I'm your host, John Pugliano. I'm also the founder and money manager at investablewealth.com. Well, hey, it's another week of turbulence in the stock market. Let's not get all excited and lose our bearings here. Let's just consider the facts and ignore all the hyperbole in the media. July through October is always the most volatile and disruptive in the market. This is the month of September. It's during an election year, and I think probably about half the electorate have come to the conclusion that their guy is going to lose in November. So that in and of itself is going to put a sour mood on, roughly half the voters. You combine that with the long and delayed lags from the Federal Reserve keeping a restrictive interest rate now for over 2 years, and we're coming off of the sugar highs from all the excessive stimulus that was done during the pandemic, which it's hard to believe that was 4 years ago. But the reason that it's still having such an impact on the economy is because that stimulus money and the impacts that governments, intervene in the economy because of this stimulus, and also consider the fact that China never even opened up their borders to international trade until January of 2023. So, it's really only been 18 months that the global economy has really reopened from COVID if you take into account that China is the second largest economy in the world and the oversized impact that decisions that they make have on the overall impact on the economy. But I'm digressing early here. Listen, bottom line, this week is similar to what we saw happen about a month ago when the market threw a little temper tantrum. At that point, though, we had the VIX spike up to hit something like 65, 68 on an intraday basis, and that was, I think, the largest in history. Right now, the VIX is only right around 22. The VIX is a volatility index. So it kind of gets you an idea of how many people are hedging against bad times over the next 30 days. Now, a 22 is extreme compared to where we've been most of this year. But that's pretty much where we sat through most of the pandemic and pandemic recovery years. So no, at this point, I continue to believe that the biggest threats to the economy are international, and that being all the geopolitical instability and really the worst we've seen in terms of hot wars pretty much since, the land wars in Europe in the 1940s. And then certainly from a Cold War perspective, you have to go into the probably 1980s to see major global powers being so suspicious of each other and taking sides. You combine that with the reality of declining global demographics, the fact that the baby boomers are all moving almost 100% into retirement, and you really just end up with a lopsided demographic economy, but it's no surprise. We've known this is coming for the last 50 years. And so here we are in September, just a few weeks away from a U.S. presidential election, and I think you can expect the markets to be choppy. And adding on to that, the fact that the economy is slowing down. But I don't think detrimentally, at least not at this point, and I really do think it's going to take a major black swan event, not just an uptick in unemployment, or even if inflation were to either have an uptick, back to being inflating or deflationary. I don't think at this point that's enough to totally throw the markets into a major correction. I'm talking, 2008 type financial crisis. I don't think we're on the precipice of that yet, just based on the slowing economy, because again, this isn't a surprise. Federal Reserve has raised interest rates to the highest in, 23, 24 years. So definitely long and delayed lags. And some have referred to what we've been seeing the last year or so as a rolling recession. I haven't used that term because I really don't think it's rolling. We'll get to that in a minute, and it has to do with the title of today's episode. Before we do, just quickly, because a lot of people are concerned about it, I want to briefly just point out here that the markets, while volatile and while definitely moving down, you have to take it in context and look at it with some perspective. The S&P 500 right now, with all the concern and drama you're hearing in the media about how the markets are falling apart, the S&P 500 is only down about 4.4% from its all-time record high. So if you're worried about this kind of a market, just wait when things could and will someday get worse. And if you drill down and look at a chart of the S&P 500, you'll see that it's still sitting above its 100-day moving average. It's been above its 100-day moving average since November of last year, with one exception, which was just about a month ago. Whenever that initial bad jobs number came out in the beginning of August, we had the S&P 500 look like it was going to bounce off its 100-day moving average, but it didn't. It fell apart, but it fell apart for like a day or two. And then it quickly bounced right on back up above its 50-day moving average. Well, now it's down below that 50 and it just hovering above the 100. Even if it fails at the 100-day moving average, generally it gets support, and not only support, but most times bounces off its 200-day moving average. And that 200-day moving average is at around 5140. That's about maybe 5% from where the market closed on Friday. So again, we're less than 5% down from the all-time record high. We've got about another 5% to go to get down to the 200-day moving average. It wouldn't surprise me at all if we did get that low, because that would give you about a 10% move from the high, which would be a classic example of a market correction. And most market corrections are resolved by bouncing back up. Now, I'm not predicting the future here. I'm just assessing probabilities. If the market drops down to its 200-day moving average, I would most likely go in and buy that dip. That's what I was setting myself up for and intending to do back in August, but it never got that low. It did incidentally get around that 5,100 number that we're talking about, which would be about 5% lower than we are right now. Because overall, back in August, I think the market dipped, 7%, somewhere around there. So basically, we'd be going back and testing the lows of August. That would put us right at around that 5140 level, which is the 200-day moving average, which is also a level slightly below that it had recovered from back in, I think it was the end of April, beginning of May, when we had that little scare then. So bottom line is there is a lot of support around that 5,000, 5150 level. And again, unless some major changes occur between now and when that happens, if we get that low, or if there is a big international black swan event, that would definitely change my mind. I might be worried at that point. But for now, if the S&P does get down to that level, I generally think it's a buying opportunity. A lot of what we're seeing right now, besides what's going on with the quote slowing economy, is simply the bloom coming off the rose of the artificial intelligence trade. Now, that doesn't worry me too much either, because we were never in the dot-com bubble levels and valuations that we saw back in the late 90s. Technology always is a growth area, right? We knew back in the 1950s and 60s that computers were going to revolutionize the world, but it didn't happen overnight. Artificial intelligence, implementation, and profitability also isn't going to happen overnight. It also is not going to go to zero and fall apart in a bankruptcy. If you look at the S&P 500, the pullback that we've had, I think has a whole lot less to do with what the media is telling you in terms of, now they're worried about a manufacturing slowdown and we're worried about unemployment. And that was really the big driver of why we saw the market correct back in early August. And the jobs numbers are still coming in weak now. That's again why the market pulled down so much on Friday. Earlier in the week, it was announced about worse than expected manufacturing numbers and contractions in manufacturing, but we're going to get, again, to all that in a minute here about manufacturing. Bottom line, though, is look at a chart of the S&P 500. It is almost identical to a chart of the NASDAQ in terms of its relationship to its moving averages, meaning that the NASDAQ just has a more dominant impact on the S&P 500 because of all the hyperscalers and the big technology stocks that are in this. We've been talking about this for, probably 2 years now, about how the big bull market and the enthusiasm and the profitability of these large tech companies, how that was pulling up the overall market, and that wouldn't last forever. And at some point, as those technology stocks went down, they were going to drag the general market with them. It used to be that the Dow Jones Industrial Average and the S&P 500 somewhat traded in a like manner. There's obviously differences between the two, but generally those big industrial companies, or what we called the Dow Jones Industrial Companies, even though a lot of them were technologies, they had an overweighted impact on the overall S&P 500, the broader market. Well, in the last few years, that hasn't been the case. It's been the NASDAQ with that overall magnetism on the general market. And the NASDAQ right now is moving down. That's what's pulling down the general market. But that doesn't mean that the overall economy is falling apart. If you look at the equal-weighted S&P 500, it's performing much better in terms of its relationship to its 50-day moving average, where the market cap-weighted S&P 500 is, trading down near its 100-day moving average. And that's also the case if you look at smaller caps and mid-cap companies with a profitability filter built in. So don't look at just the general small caps, but look at what's called the S&P 600, which is a select group of profitable smaller companies. They're holding up much better than you would think, given the nature of how more volatile and fragile smaller companies are. So I think if we were really on the precipice of falling off unemployment and an economic slowdown cliff, then I think that you would see the smaller caps do much worse than they are. Bottom line, look at the S&P 500 overall, even on a cap-weighted basis. It's only down 4.3% from its all-time high. Not a reason to panic. But we'll have to wait and see. I entitled today's episode, Manufacturing Recession, 2 Years and Counting, because especially this week, the media has had a big focus on the manufacturing slowdown. Well, the reality is that we have been in a manufacturing slowdown for like 24 months or longer. If you go back and look at the Conference Board leading economic indicators, which had me really concerned all through 2023, mostly because not only the overall indicators being down, but the lack of improvement in manufacturing, well, none of that's changed. I think in the last 24, 25 months, there's been maybe 1 or 2 months when manufacturing has actually been either at or above 50 on a PMI index, which is basically to say that anything above 50 is expansion and anything below 50 is contracting. Well, we've been contracting for nearly 2 years now, but manufacturing hasn't fallen off a cliff. In recent months, you've seen me move more into manufacturing type stocks, everything from specialty chemicals to equipment companies to railroads. And I think that we, after 2 years are probably at a point where we're going to come out of that slowdown simply because things eventually get better, if for no other reason than you're comparing them to lower performance in the recent data. So even if they stay stable, it isn't as bad as it had been. But there's more than that. You've heard me talk for years now about the fact that energy prices, and in particular natural gas, because of our vast reserves and the way we're able to get it now as a result of horizontal drilling and the fracking revolution, well, that just means that we have the world's top reserves for natural gas and the lowest prices. And natural gas is a feedstock not only for the petrochemical and plastics industries and just about everything else you can think of, from pharmaceuticals to fertilizer, but it also gives you the low-cost energy that you need to make those items to begin with. And for about the last 10 years now, that has been drawing more and more manufacturing back to the United States. When you add into that all the geopolitical fragileness and instability of the global supply chain that so many people had a just-in-time delivery system relying on, well, all that combined with the trend of lower cost and vast availability of natural gas, along with this technological revolution in robotics and artificial intelligence, means that labor costs become less significant than they were in the past, and suddenly you're going to start to see more things being made in North America and in the United States, and that overall will have a good long-term impact on the economy. So right now, with things slowing down and unemployment going up, I think those are just a continuation of what the Federal Reserve's policy has been for the last 2 years. We know they tried to create a recession in 2023. They were unsuccessful. I've always said that they didn't want to create one in 2024 with the Democratic incumbent presidency running for re-election. I think that's still the case. And there'd be really no reason for them to create one in 2025 because it does look like the worst of inflation has come under control. And really, that I do think remains their biggest problem. I don't think it has anything to do with a slowing manufacturing or increasing unemployment rate. I think the real threat to the economy is if inflation continues to go higher. But take a step back and look at the raw materials. Do you know that right now, copper is only a little bit more expensive than it was a decade ago? Back in 2013, say copper was trading right around $3.90 something a pound. As of today, it's like $4.07. So when you look at the extreme prices that we've seen in products and services, these raw materials have come back down to earth in terms of pricing. Look at lumber prices. Look at iron ore. Look at oil. Again, oil is cheaper today, even with all the turbulence going on in the Middle East. Oil is cheaper today than it was in 2013. The only thing that's really costing more from an input basis is labor costs. And so increasing unemployment is not necessarily the problem you would think it is to the economy. Now, of course, like Ronald Reagan had said, 40 years ago, it's a recession when your neighbor loses his job, and it's a depression when you lose yours. So yes, employment is a big thing on an individual basis, but from the masters of the universe that control monetary policy, they want higher unemployment to stabilize labor prices. So what's occurring right now with a slowdown in manufacturing and an increase in unemployment, I don't think is something to be overly concerned about because it's been part of the monetary plan. And my major concerns continue to be external. I'm worried about black swan events on a geopolitical instability basis, but that's something that we can't predict. It's something that we can't control. So again, I'm watching these markets. If we do get down to that 200-day moving average on the S&P 500, all things being equal as they are today, I think we bounce off of that level, and I think it's a good buying opportunity. And I am going to continue investing in stable, profitable technology and manufacturing and industrial-oriented companies that are right here in the United States. Oh, and one other thing I'll add in just to be a troll at the end of the podcast here. I think come November, it's all going to get resolved, and just like every post-election period, it isn't going to matter. Because the rich SOBs that control the world always remain being the rich SOBs that control the world. On a macro scale, it doesn't matter who's in the White House, and on a micro scale, the only thing that really matters in the short or the long term is who's in charge of your house. So hey, take that for what it's worth. Until next time, as always, this is John Pugliano wishing you the very best returns.